You saved $10,000 last year. You did everything right. No impulse purchases. No subscriptions you didn't need. You were responsible. But here's the thing nobody told you. You're poorer than you were 12 months ago. Not because you spent it, because you saved it. Stay with me, because what I'm about to show you will change the way you think about money forever. Welcome back. Today we're talking about one of the biggest financial myths out there, that saving money is always a smart move. Don't get me wrong, saving is better than spending recklessly. But if you think stashing cash in a regular savings account protects your wealth, the math says otherwise. Let's break it down. Section 1. What is inflation? Inflation is the slow, invisible force that makes everything more expensive over time. That coffee you paid $3 for 5 years ago, it's $5 now. That apartment that rented for $800, it's $1,200 today. Every year, the purchasing power of your dollar shrinks. On average, inflation runs around 3 to 4% per year, and in some years, it's been much higher. So here's the question you need to ask yourself. Is my money growing faster than inflation? If the answer is no, and for most savings accounts it's definitely no, then you're losing money in real terms, even while your balance grows on paper. Section 2. The math that changes everything. Let's get specific. Say you put $10,000 in a standard savings account. Most traditional banks offer around 0.5% annual interest. That means after 1 year, you've earned $50. Sounds okay, right? Now here's the problem. If inflation is running at 3.5%, the purchasing power of your $10,000 has dropped by $350. So your real loss? About $300 in a single year. Keep that money sitting there for 10 years, and you haven't just missed out on growth. You've quietly lost thousands of dollars in real value without ever spending a cent. Your account balance went up, but what that money can actually buy went down. That's the trap. Section 3. Why banks don't tell you. Here's something worth understanding. Banks take the money you deposit and lend it out at much higher interest rates, sometimes 6, 8, even 20% or more on credit cards and mortgages. They're making serious money off your savings. In return, they give you 0.5%. That's not an accident, that's the model. The system isn't designed to grow your wealth. It's designed to borrow it cheaply and profit from it. And most of us have just accepted that as normal. Section 4. So what should you do instead? Okay, so if a savings account is a slow money leak, what are the alternatives? Here are a few worth knowing about. 1. High-yield savings accounts. These are still savings accounts, but offered by online banks that don't have the overhead of physical branches. Right now, some are offering 4 to 5% APY, which actually beats or keeps pace with inflation. Good for your emergency fund, money you'll need within 1 to 2 years. 2. Index funds. These track the overall stock market, like the S&P 500. Historically, they've averaged 7 to 10% annual returns over the long term. Good for money you won't need for 5+ years. 3. I-bonds, inflation-protected bonds. These are government-issued bonds where the interest rate is tied to inflation. When inflation goes up, your return goes up with it. Good for medium-term savings with inflation protection built in. 4. Real assets. Things like real estate or even commodities tend to hold their value against inflation over time. Good for longer-term wealth building. Now, none of these are get rich quick, and I'm not a financial advisor. You should always do your own research before making any financial moves. But the point is this: you have options, and doing nothing is actually doing something. It's choosing to lose. Section 5. The mindset shift, 6 to 6:45. Here's the real lesson. Saving money is not the goal, it's the foundation. Step 1. Save consistently. Build your emergency fund. Get out of high-interest debt. Step 2. Put that money to work. Because money sitting still isn't neutral. In an inflationary world, it's retreating. The people who build wealth over time aren't the ones who save the most. They're the ones who understand that every dollar should have a job. Whether that's beating inflation in a high-yield account, growing in an index fund, or compounding in an asset that appreciates, your money needs a strategy. Outro and CTA. So the next time someone says, just save your money, you'll know the full picture. Saving is smart, but only saving is a strategy that quietly works against you. If this opened your eyes, hit subscribe, because next week we're going all in on compound interest. And I promise you, the numbers are going to surprise you. See you then.